This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 17 of Value Investing. In this episode, I want to go over the capital allocation decisions that executive teams have to make in the public company. They have a lot of options available, and I want to go over each option and see which one is good and which one is not, which one makes sense, which one doesn't make sense in various situations. And I'm going to try to quote what Warren Buffett says in every situation, and just to hear what legendary investor Warren Buffett thinks about capital allocation decisions by executives in the public company. I think this is going to be very interesting and important topic because in the previous episodes, I mentioned that you have to look at certain criteria in order to find out good investment opportunities. The most important one is the business model, and second one is the good and honest management team. And the good and honest management team can be spotted in various ways, but one of the ways you can spot good and shareholder-friendly management team is by looking at how they spend their money. So once the earnings are made from the business, the management team has to be cautious and has to spend or invest this money on behalf of shareholders, and they have to act in the best interest of shareholders, but that's not necessarily the case if you look at their capital allocation decisions. So I'm so excited to have this episode, and I'm excited to talk about more in detail. But before I start, I just want to give you a quick disclaimer that this podcast is for entertainment purpose only, and I'm not here to provide any advice to buy or sell certain market securities. It is your responsibility to consult with your investment professional for any investment decisions. Additionally, you can go to valueinvesting.blueberry.net, and that's my value investing podcast website. You can leave your comments or feedback on this podcast, and I'll try to make sure that I read every comment. And your comment is valuable, and 5-star review always goes a long way. Without further ado, let's get started. Every public company listed in the US and other country has to report their financial statement every quarter. And if you look at the bottom of income statement, you have the item called net income. This is the earnings that the business has made during the quarter or during the year. And as an investor, technically this is your money. So you have to really watch out for how the management team is spending or investing this money. Because if the management is not careful, they're going to just waste the money. And if management makes the good capital allocation decision in terms of allocating these earnings back to business or distributing back to shareholders, if they make a good decision, your money is going to be well invested or spent, and your investment is going to go up in value over the long term. So as a long-term investor, it is important for you to understand how management thinks about their earnings from the business and how carefully they do make a decision on their earnings. So let's just go over, and I'll try to incorporate what Warren Buffett thinks about capital allocation decisions and what it's supposed to be. There are just many options that management can choose. Let me just go over each option quickly and then go into more details. The first option, this is actually not an option, but first thing they have to do is reinvest back into the business in order to maintain the current economic position and business operation. The second one that management can do is reinvest the capital back into the business to grow the business organically. So they can do various things like opening a new branch and buying new machines and buildings, and these are the things that management can do. third option that management has is grow the business inorganically through M&A activities, so they can buy a bunch of other businesses if they have excess capital available. And fourth option they can do is they can just park the cash in the marketable securities such as Treasury Bills. They can just make some small interest on these securities, but that's something they can do. So those are the four options that management team has in terms of retaining earnings in the business. Also, the other two options that management can choose to do is to distribute their earnings back to shareholders. The first one is buying back shares in the market, and the other one is distributing money to shareholders in the form of dividends. So these are the 6 different options that in general are available for management team to handle earnings. And let's go into each item and see what really makes sense in different situations. The first one, as I mentioned, is not technically an option because every single business has to reinvest a certain amount of money back to the business in order to just maintain their current economic position or business operation. Think about any business. If you have, let's say, if you're trying to make some shoes and you have your factory, then you have to maintain your machinery, you have to maintain your buildings in good shape, and you have to manage your inventory. There's a certain amount of money necessary in order to maintain the current business operation. And I'm not talking about growing the business. I'm just talking about just maintaining the status quo. It's going to require some amount of money. So this is what Warren Buffett calls restricted earnings. He's saying that this is not option. Even if the return on earnings is very small on these activities, you still have to invest back into the business. So Warren Buffett said, quote, "Were these earnings to be paid out, the business would lose ground in one or more of following areas: its ability to maintain its unit volume of sales, its long-term competitive position, its financial strength. No matter how conservative its payout ratio, a company that consistently distributes restricted earnings is destined for oblivion unless equity capital is otherwise infused." So what Warren Buffett says is basically, if you don't reinvest a certain amount of money back into the business, then the business is going to be less competitive and eventually will die out. And as a long-term investor, you have to accept the fact that a certain amount of money is going to be reinvested back into the business. But here, I want to point out that not every company requires the same amount of capital. For example, if you look at airline industry or railroad industry or utility industry, like a lot of companies in such industries require a lot more capital invested back into the business just to maintain their current economic capital position. A lot more. You can think of this one percentage relative to revenue, but whatever metric that you use, you'll see that airlines, railroads, and utility companies will need a lot more capital reinvested back into the business just to maintain their operation. So when you're making investment decision, this is like I'm talking a little bit off the tangent here, but if you really want to find good businesses with good business models, then you probably want to avoid companies in capital intensive industry, because this is the money not really coming back to investors. You can think of this money as expense. So if you look at capital expenditure item in the cash flow statement, you'll find that which one is capital intensive industry versus not. So we just talked about restricted earnings, and all the other options that I'm going to tell you going forward are all unrestricted earnings the term that Warren Buffett mentioned in his 1984 shareholder letter. Warren Buffett said, quote, "Unrestricted earnings should be retained only when there is a reasonable prospect that for every dollar retained by the corporation, at least $1 of market value will be created for owners." So let's just try to understand what he means by this, because people get confused a lot. This is a simple concept. So management team has various options available for them. And one option is reinvest this money back into their business and try to grow the business organically. Or they can buy another business through M&A activities in the market. And they can park their cash in their balance sheet. So those are the three main options for unrestricted earnings available for them. But when it comes to unrestricted earnings, what Warren Buffett is saying is that management has to assess the return on unrestricted earnings and make sure that the prospect of return is greater than what's available in the market. For example, if the management team pays out this one in the form of dividends, the investors can invest the money in the market, for example, S&P 500 stock index, and they can fairly make approximately 6 to 8% over the long term. So if management believes that there's no project available that is greater than 8% return, and if there's no project available in terms of M&A activities that's going to bring more than 8% return, then the management has to distribute earnings back to shareholders. But that's not necessarily the case, and I'm going to just quote Warren Buffett here again. Warren Buffett said, quote, "For a number of reasons, managers like to withhold unrestricted, readily distributable earnings from shareholders. To expand the corporate empire over which the managers rule, to operate from a position of exceptional financial comfort, and etc." Warren Buffett is basically here saying that if the management team doesn't distribute these earnings back to shareholders, there are a lot of things they can do to enrich themselves. So that's something that you have to watch out when you are long-term investor, and you have to pick the right management team. Otherwise, they have 1,000 different ways they can do with your money. At this point, let's just get into more details of each option with respect to unrestricted earnings and see what kind of situation really justify unrestricted earnings to be reinvested back to business instead of being distributed to shareholders. The first option and second option, as I mentioned, is reinvested back to the business to grow the business organically. For example, opening a new branch or opening a new store. And also, the second one is grow the business inorganically through M&A activities. The management team can go out and buy another company in the same industry. So both of them make sense if management truly believes that the prospect of high return on such activities. If such activities can produce higher return than what market provides at that point, I think it makes sense. That's what Warren Buffett said. And if you really want to understand how things turn out, you can look at past performance of management team and see what is the return on equity and return on invested capital has been in the past, because that is a proxy that you can use to understand what kind of returns that management team has generated through various projects and through various M&A deals in the past. It's important for you because, as I mentioned, this is your money. If they are not investing your money in a profitable manner, then it's better and it's your right to demand your money back to you as shareholders of the company. The third option that I mentioned is management can also park the cash in the marketable securities. in certain situations, this makes sense because companies always need a certain amount of liquidity. So they want to have enough cash in order to avoid any bankruptcy and in order to avoid any liquidation. They always have to pay a certain amount of money to their vendors and to banks from which they borrow money. So if you look at quick ratio and current ratio, those are the two metrics that I would use to understand how much cash the management team decided to have on their balance sheet, because you can tell the current liability and versus current asset and try to understand if management is efficient in terms of having cash on their hands. If there's too much cash, then that's not efficient way of running the business. But if it's too little cash, then they might face the risk of going bankrupt. So those are the three options that are available for management to retain their unrestricted earnings in the business. And this is preferable option for some managers because, as Warren Buffett mentioned, in some cases they do not really behave in the best interest of shareholders, but they want to enrich themselves. So you have to watch out. There are a lot of good outstanding managers who are not like that, but this is a good area for you to investigate further. And there are certain metrics that I mentioned that you can take a look. For example, return on invested capital, and also quick ratio, current ratio, just to understand how they think about allocating the capital back into the business. So these are the three options for unrestricted earnings for the business, and there are two options which the management can use to distribute the unrestricted earnings to shareholders. First, share repurchases and dividends. These are very, very important policy that company has to decide on behalf of shareholders. As I mentioned in this episode, when it comes to deciding whether the management team has to retain their earnings in the business or distribute earnings back to shareholders, the management team has to assess the available projects in the business and make sure that these projects have the prospect of generating higher returns than what the market can provide. So that's simple. But once the management team decides to distribute earning to shareholders, they also have to make a decision whether they want to do it in the form of dividends or share repurchases. In 1999, a shareholder letter, Warren Buffett mentioned when is the good time for share repurchases. Warren Buffett said, quote, "There is only one combination of facts that makes it advisable for a company to repurchase its shares. First, the company has available funds, cash plus sensible borrowing capacity beyond the near-term needs of the business. And second, finds its stock selling in the market below its intrinsic value, conservatively calculated." So this is an important point. Warren Buffett is saying that the company first has to have enough cash on its hand. Also, the second one, the security should be selling below its intrinsic value. Because if you look at a lot of companies nowadays, they buy back shares regardless of the price that is selling in the market. They are not really behaving in the best interest of existing shareholders, because if they just want to support and prop up the stock price, then share repurchase makes sense. But if you really want to bring value to the shareholders, then the management team has to repurchase shares only when the current price of the security is below intrinsic value. Then why do so many executives love to repurchase shares when it is not really helping long-term shareholders? Even when the current stock market price is way above their intrinsic value. I think that the reason why it is so prevalent nowadays is because a lot of executive compensation is tied to stock options and also tied to the price of the stock. So if you have, as an executive, if you have a lot of stock options, dividends will not really help you much because you're not going to receive the dividends if you have stock options. But stock options only become valuable when the price of the stock is high at certain point in time. You can redeem your stock options if your stock option exercise price is below the current market value. So in that sense, it makes a lot of sense for executive to buy stocks in order to support the price, and that makes more sense. But if you distribute the capital back to shareholders in the form of dividends, then the stock price actually goes down in theory. And also, in many cases, their compensation is directly tied to the price of the stock. And that actually led to a lot of share buybacks. And also there are a lot of short-term oriented shareholders who don't really care about all these things. They are happy as long as the stock price is high and as long as they can get out of the position with high stock price. So exiting shareholders will benefit from share buybacks, but not long-term shareholders. However, if you look at the opposite case where the current market valuation of the stock is a lot lower than intrinsic value of the company, then the management's action to buy back shares is going to be enormously beneficial for long-term shareholders. So you have to look at the situations differently and then try to conservatively value the company and only trust the management team if they say that the buyback is good for shareholders when the intrinsic value is a lot higher than the market price. Also, one benefit of buying back shares compared to paying out dividends is the fact that you don't have to pay income tax, because if the capital is distributed to you in the form of dividends, then you have to pay income tax, which can be very high if your income tax bracket is high. So that's one downside of the dividends, and that's why Warren Buffett is reluctant to pay dividends to his shareholders. Another downside of the dividends compared to share repurchases is the fact that you can do share repurchase as you wish in terms of the magnitude, in terms of frequency, but if you declare dividends, then shareholders would expect that you pay out these dividends, whether it's quarterly or yearly. Then they want consistent dividends going forward, and you always have to take into account the long-term prospect of the business whenever you decide the dividend policy. So once you set the dividend policy, there's no going back. It's really going to be hard for you to pull back whatever dividend policy that you declared, because shareholders will react in a very, very negative way once you repeal whatever dividend policy that you have. So look at what happened to GE stock, because GE stock has gone down significantly because of business fundamental deterioration, and also the company announced that it's going to cut its dividend in half, and that actually led to huge drop in price. Okay, that's it for today's episode. In this episode, we've talked a lot about various options available for management team to handle their earnings. And we talked about restricted earnings and unrestricted earnings, and what really makes sense for management team to choose a certain option out of many. And this is also a good way for you to understand whether the management team is shareholder friendly or they are trying to just enrich themselves. And there are a lot of outstanding and good managers out there. And also there are bad managers out there, and it's really hard to see just based on what they say, and hard to judge who is good and who is bad. But if you look at certain metrics that I mentioned in this episode, and if you look at the way they handle their capital allocation decisions, you should be able to have a better picture of finding out good and outstanding management team for your investment decisions. I hope you enjoyed this episode. And before I end, if you haven't already done so, please subscribe to my channel, and you can always go to my website valueinvesting.blueberry.net to leave your comments or feedback, and any feedback is welcome on the website. And thank you very much, and see you next time.